You are at a dinner party in Pune. Your neighbor's brother-in-law leans across the table and tells you about a small company in Nasik, a family-run business that started during COVID, nearly shut down twice, survived on willpower alone, and then tripled its revenue. The founder mortgaged his house. His wife ran the accounts. Now they are thinking of listing on the SME exchange. You haven't seen a single balance sheet. You don't know the debt to equity ratio. You haven't checked whether the sector has tailwinds or headwinds. But somewhere inside, you are already half convinced this is a worth a look. Now compare that to this. Your financial advisor emails you a 14-page research report on a SEBI registered large cap fund. 5-year CAGR, Sharpe ratio, standard deviation, rolling returns, etc. You bookmark it. You mean to read it this weekend. You probably never will. Here's what I want you to hold on to as you watch this episode. Why does the first scenario pull you in and the second one put you to sleep? Same money at stake, but completely different reaction. The answer is not discipline. It's not intelligence. It is biology. And in this series, we have been building the case for exactly this idea, that the decisions we make with our money are not made by rational calculators. They are made by human brains. Brains were shaped for a world that did not have stock markets, mutual funds, or research report. This is topic 8 of module 1, and today's bias is arguably the most seductive one we have covered so far. It is called the narrative bias, and it is quietly running in your portfolio. Here is the plain language version of what the narrative bias is. Your brain is not built to process data. It is built to process stories. When you hear a sequence of facts, revenue grew 22%, operating margins compressed by 4%, cash flow positive for 3 quarters, your brain stores them as a separate, disconnected item. It takes effort to hold them together, and effort feels like work. But when you hear this founder mortgaged his house and built something from nothing, your brain connects it instantly to every underdog story you have ever heard. It feels familiar. It feels true. It feels like something you understand. This is not a flaw in your character. This is how human beings communicated and survived for thousands of years. Stories are how we pass down danger warnings, food sources, and social codes long before spreadsheets existed. Here is the bridge. The moment you open a financial app or sit in a broker's office, that ancient story processing brain is the same one evaluating your investment. The moment someone tells you a compelling story about a company, your narrative brain lights up and your analytical brain steps aside. That is why this is topic number 8, not topic number 1. Every bias we have studied so far has been feeding into this one. The narrative bias is where all of them converge. Let me take you to an Indian wedding. There is always one relative, you know, the one who pulls you aside between the fairas and tells you about a fantastic land deal in some tier 2 or tier 3 town. No documents, no registry papers, just a story. Yeah, I know the seller personally. His father held this land for 40 years. The highway is coming right next to it. And somehow people invest. Without paperwork, without due diligence, because the story is vivid. The relationship is warm and the narrative makes sense. Now think about how differently you treat a mutual fund. Same money, but suddenly you want fact sheets, exit flows, and 3 years of historical NAV charts. Why the double standard? Because in the land deal, there is a character, a real person with a real history and a real family backstory. In the mutual fund, there is only a PDF. Stories beat PDFs every time. That is the narrative bias working on you in real time. And here is what this makes this particularly dangerous in markets today. The financial industry knows this about you, and some of it uses that knowledge deliberately to shape what you buy. Here is what most people miss about the narrative bias. It doesn't just make you invest in bad things. It also makes you avoid good things that are hard to explain. Ask yourself, have you ever skipped investing in a company because when you tried to describe it to someone, you couldn't make it sound exciting? It makes industrial fasteners for the auto sector. Not glamorous, not a story. Meanwhile, you heard about an EV startup. a fintech unicorn, or a disrupting the traditional banking sector pitch. And suddenly you were interested. Even though the fundamentals were thin, the narrative pulled you towards complexity and excitement and away from boring compounding profitability. Some of India's best performing companies over the last 2 decades have been deeply unglamorous businesses. Manufacturers of bearings, providers of industrial gases, companies that make pipes. No exciting founding story, no celebrity CEO, just steady, profitable, repeatable business, year after year. But they never got the dinner table conversation because they had no story worth telling. The narrative bias is a two-way trap. It draws you towards the exciting and pushes you away from the durable. And the market exploits both directions with equal efficiency. Let me make this concrete. Two companies, same decade, 2014 to 2024. Company A makes specialty chemicals for the textile industry, boring, cyclical, no media coverage. Over 10 years, it compounded returns at roughly 19% CAGR. 10 lakhs invested in 2014, approximately 56 lakhs today. Company B was a new age consumer brand. Fantastic story. D2C model, founder on every podcast. Valuation of 4,000 crores at peak. Went public in 2021. Currently trading at 60% below its IPO price. Which one got more attention in 2021? Which one appeared in more stocks to watch YouTube videos? Which one flooded the WhatsApp groups? You already know the answer. The story won, the numbers lost, and so did the investors who followed the story. That gap between 56 lakhs and a loss is not a bad luck. It is a narrative bias that is priced in rupees. Now let's look at how the industry uses this against you, because this is the part most financial content will never tell you. Fund houses, distributors, and product manufacturers know about the narrative bias, and some of them use it deliberately to sell you products. Invest in India's infrastructure story, ride the digital India wave, be part of the electric vehicle revolution. These are not investment theses. These are stories dressed up as the investment thesis. And the difference matters enormously. A story says this sector will grow and therefore you should invest in this fund. An investment thesis says these specific companies at these specific valuations with these specific balance sheet characteristics offer you a margin of safety and a reasonable expected return over a defined time horizon. One of this takes 30 seconds to understand. The other takes 30 hours of work to build. The 30-second version is what gets sold. The 30-hour version is what actually protects your money. Every time you buy a thematic fund, because the themes sound compelling, the story is doing work that the data should be doing. And every time the story does that work instead of the data, you are paying for the privilege in real rupees over real years. Why does this happen? The same reason every other bias in this module happens. Your brain has a deep ancient need to establish cause and effect. If that bush moved yesterday before a predator appeared, remember it and act next time. Pattern recognition kept humans alive for millennia. But in markets, this instinct becomes a liability. Your brain connects your action to a subsequent outcome and creates a false memory. I understood that. I called that right. Over time, you build an entire personal mythology of your investing skill, and that mythology is, at its core, a story your brain told you to reduce anxiety. If you have read our earlier pieces on the amygdala, on cortisol, on the dopamine loop, you will recognize this immediately. The story is the emotional shortcut, and the brain will always take a shortcut over doing the analytical work if you let it do. The narrative bias is not separate from the other biases in this module. It is the output of all of them running together. So what do you actually do with this? The goal is not to become someone who ignores story entirely. Stories are useful. They help you identify sectors and companies worth investigating. The problem is when the story replaces the investigation instead of starting it. Here is a two-step filter you can apply every time a narrative pulls at you. Step 1. Separate the story from the data. Write down in one sentence what the story is. This company is disrupting logistics in India. Now set that sentence aside. Open the annual reports, look at the last 5 years of revenue, operating profit, and free cash flow. If those numbers are good, the story gets a chance. If those numbers are not good, the story does not save the investment. The story is the invitation to investigate. It is never the investigation itself. Step 2. Ask who benefits from telling you this story. Every story has a narrator. When a brokerage upgrades a stock with a 14-page full of compelling narrative, ask yourself, is this firm also the book-running lead manager for the company's upcoming QIP? When a mutual fund launches a new India consumption theme fund, ask yourself, is this a genuine opportunity or a marketing moment to gather assets under management? The narrator's incentive matters always. And a third check, the reverse test. Before you click buy, ask yourself, if this were a boring pipe company instead of an exciting EV company, would the numbers still make me want to invest? If the answer is no, then the story is carrying the decision, and you have found the narrative bias at work inside your own portfolio. Charlie Munger, one of the greatest investors of the last century, often said the best investments he ever made were the ones he could describe to a 12-year-old. Not because the story was exciting, because simplicity often means durability. A simple business with great numbers is worth owning. An exciting story with weak numbers is not. Excitement is not evidence. A compelling origin story does not pay dividends. A founder's resilience does not generate free cash flow. The market does not reward the best story. It rewards the best business, eventually and always. The narrative bias is the place where your amygdala, your cortisol response, your pattern recognition, and your dopamine loop all meet. It is the bias that selects all the other works at once, because a good story activates every one of them simultaneously. Which brings us to the question this entire module has been building towards. Given that we all are wired this way, to prefer stories over spreadsheets, narratives over numbers, excitement over durability, how do we invest intelligently anyways? That is the question. And it is the question the rest of this series exists to answer. Next up in Module 1, Cognitive Load. How information overload leads to decision paralysis and what to do about it. See you in the next one.